So what are the average retail investors, Lizanne, telling your company now about their confidence level and where they're willing to invest and where they might want to put their money?
There is a little bit more diversity of opinion now than, say, 2 years ago, where there was unquestionably universal pessimism. I think you can find still the extreme pessimists, but I also find a lot of extreme optimists right now. So it's a little bit of a mixed bag. I think back to late 2007 when I started to get very negative about the economy and the market. And at that time, I felt like I had to apologize for pessimism. And then fast forward to the end of 2008, no one had to apologize for being pessimistic. In 2009, being an optimist, I felt like I had to apologize for that optimism. Now you don't have to apologize anymore. So I think there's a little bit more hope. It's not yet manifesting itself in any significant way in terms of what investors are doing. I think they're still, to some degree, in the bunker.
On the sidelines.
To some degree. I think they've started to move some money in, but it's nothing that would represent any kind of sentiment extreme. So they're talking a little bit more optimistically. The actions still show some latent skepticism.
What about you, Sam? I mean, you're dealing with financial advisors all the time that are then dealing with their retail clients. What's their appetite for risk in this market?
Well, it's more how much more frustration might they be able to take in 2011 that they are telling their clients, look, in the first year of a bull market, we tend to see tremendous explosive growth. In the second year, second verse, same as the first, we end up with very strong performances. And so basically they've been telling their clients, don't be at the airport when your ship comes in, and unfortunately they have remained there. So I think for 2011, they want to make sure that their clients don't continue to miss out on good long-term investment opportunities, but at the same time making sure that at the end of the party they don't go too far out on the risk curve and then just hurt themselves once again.
We've seen certainly in recent years what that does. Lizanne, in terms of where Schwab is advising investors to put their money, are there any certain asset classes that you guys see more attractive than others? We've heard so much about commodities, gold, even silver to a greater extent as being these safer and wiser investments now.
Well, an important sort of 30-second preview for how we approach asset allocation. We are big believers in strategic asset allocation and figuring out where the investor sits on the risk spectrum and then establishing a portfolio for that particular investor. So for a more conservative investor, we would recommend much less exposure to the high-risk asset classes and more exposure to the more conservative asset classes, the complete opposite for an aggressive investor. So we don't have one cookie-cutter recommendation that's applicable to all investors. And once you establish that, then we think you want to basically stick with that exposure and then rebalance. But what we try to do is be very proactive in reminding people about appropriate times to rebalance. So we have been saying, be cognizant of paring back some profits that you might have in things like precious metals or emerging markets. Focus in on areas, for instance, the U.S. equity market, where you may now have some underexposure, either because you haven't been putting money there or in relative appreciation terms, you've made some gains elsewhere.
I mean, from what you're saying and from your note, it sounds like you're, whether it's China or other emerging markets, you say, they're a little bit overblown right now.
I don't know that I would yet use the bubble term for some of these, but purely from a fundamental valuation perspective, I think that the spread to me in favor of the U.S., i.e. fairly expensive emerging markets, suggests a little bit of a reversion to the mean, a little bit of a reallocation that could be underway. I would also say I think very clearly what is happening in the very near term is a reallocation away from bonds, particularly treasuries, and I think some of that money will find its way into U.S. equities as well.
What do you think, Sam? You agree? I mean, U.S. equities may be a wiser bet going into 2011?
I think certainly it has very good upside potential. I do want to add that I don't necessarily think that diversification failed us during the most recent market decline. I think our memories and our expectations failed us. That actually a 60-40 portfolio fell less in 2008 than it did in 74, 37, and 1931. So basically it did what we were supposed to do. I would basically say to investors, remember to diversify among low correlated assets, or make sure that they zig when the other ones zag. If you go too far out on the risk curve, if you have too many investments that act in a very similar manner, then you're just going to replicate the problems of 2008 when we do have a market decline. I think, though, that from a valuation standpoint, we're trading at about a 22% discount to the average PE in the last 22 years, and we're almost equal to the average PE since 1936. So valuations do not look